How much money do you really need to start investing in India? 10,000 rupees? 1 lakh rupees? Or maybe you've been told investing is only for rich people? So you wait, you save, you delay, and slowly time moves ahead. But here's something most people never realize. The biggest mistake is not starting small. The biggest mistake is not starting at all. Because money is not the real problem. Lack of direction is. No plan, no structure, no system. And when there's no system, even big money gets wasted. But when there is a system, even small money compounds. In this video, you will understand exactly how much money you need to begin, how to build your first investment system, and how to grow it step by step. No confusion, no unnecessary complexity. Just a clear path. Stay with me till the end. This might change how you look at money forever. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Remove the myth about starting money. You don't need a big amount. You don't need a perfect salary. You need a starting point. In India, you can begin investing with just 100 rupees. 500 rupees is practical. 1000 rupees is a strong starting base. Let's think clearly. If you wait until you have 1 lakh rupees, you are delaying your journey. And delay has a cost. Because compounding needs time, not perfection. A person investing 2000 rupees every month for 20 years can build more wealth than someone investing 1 lakh rupees once and stopping. So, don't wait for big money. Start with available money. The market rewards consistency, not hesitation.
Step 2. Create financial stability first. Before investing, you need protection. That protection is called an emergency fund. This is not optional. This is your financial safety net. Calculate your monthly expenses. If you spend $20,000 per month, you should have $60,000 to $120,000 saved. Keep this money in a safe place. Savings account, liquid mutual funds. This money is not for growth. It is for unexpected situations. Job loss, medical emergency, family needs. Without this, you will break your investments during crisis, and that destroys long-term growth. Step 3. Start with SIP. Build discipline. SIP means Systematic Investment Plan. You invest fixed money every month. No guessing, no timing. Example, you invest $3,000 every month. When markets fall, you buy more units. When markets rise, you buy fewer units. Over time, your average cost balances out. This is called rupee cost averaging. It reduces risk and removes emotional decisions. SIP is not about returns. It is about behavior, and behavior builds wealth. Step 4. Choose simple investments. Beginners don't need complicated strategies. Start with mutual funds, index funds, large cap funds. These are simple and effective. Avoid stock picking in the beginning, because stock selection requires skill and experience. Mutual funds give diversification and professional management. Keep it simple. Simple is powerful. Step 5. Build a clear asset allocation. Don't put all money in one place. Divide your investments. A basic allocation can be 60% equity, 30% debt, 10% gold. If you are young, you can increase equity. If you prefer safety, increase debt. Equity gives growth. Debt gives stability. Gold gives protection. This balance reduces risk and smoothens returns. You don't need complexity. You need structure. Step 6. Understand market cycles. Markets move in cycles. There will be growth. There will be crashes. Example: your $50,000 investment can drop to $40,000. This is normal. This is not failure. Most beginners panic here and exit, but experienced investors stay calm because they understand markets recover over time. If you stay invested, you benefit from recovery. If you exit early, you lock your losses. Patience is a skill, and it is rewarded.
Step 7. Rebalance regularly. Once a year, review your portfolio. If equity becomes too high, shift some money to debt. If equity falls, add more. Example: your target is 60% equity, but market growth pushes it to 75%. You reduce it back to 60%. This locks profit and reduces risk. Rebalancing keeps your plan stable. It is not about prediction. It is about discipline. Step 8. Understand basic taxation. Taxes affect your real returns. In equity, if you sell within 1 year, short-term tax applies. If you hold more than 1 year, long-term tax applies. Currently, gains above 1 lakh rupees are taxed. Debt investments have different taxation rules. You don't need deep knowledge, but basic awareness is important, because what you earn is not what you keep. Step 9. Avoid beginner mistakes. Mistake 1. Waiting for the perfect time. Mistake 2. Following random tips. Mistake 3. Investing without understanding. Mistake 4. Checking portfolio daily. Mistake 5. Panic selling during market fall. Mistake 6. Investing too much too fast. Mistake 7. Ignoring asset allocation. Mistake 8. Lack of patience. These mistakes are common, but avoidable. Awareness protects your money. Step 10. Increase your investments over time. Starting small is fine. Staying small is not. As your income increases, increase your SIP. Example: start with 2,000 rupees. Next year, 3,000 rupees. Then 5,000 rupees. This is called step-up investing. Even small increases create massive long-term impact because compounding accelerates. Growth becomes faster and stronger. Step 11. Think long-term. Investing is not a shortcut. It is a process. Wealth takes time. 10 years, 15 years, 20 years. The longer you stay invested, the stronger compounding works. Example: 5,000 rupees per month for 20 years can grow into a significant corpus, but only if you stay consistent. Short-term thinking destroys wealth. Long-term thinking builds it. Step 12. Control emotions. Follow system. Markets test your patience. Fear during crashes, greed during bull runs. Both are dangerous. If you follow emotions, you will make mistakes. If you follow system, you stay consistent. Invest regularly, review periodically, stay calm. Discipline is your biggest advantage. Not intelligence, not luck, just discipline. Step 13. Focus on income growth. Investment is powerful, but income is the fuel. If your income increases, your investments increase. If your investments increase, your wealth grows faster.
Learn new skills. Improve your career, because higher income means higher investment capacity, and that accelerates everything. Step 14. Track, but don't obsess. Review your portfolio once every few months, not daily. Daily checking creates anxiety and emotional decisions. Investing is slow. Growth is gradual. Trust the process. Let time do its work. You don't need a big amount to begin. You need a clear direction. You don't need perfect knowledge. You need consistent action. Start small. Stay consistent. Think long term. Years from now, you will not regret starting small. You will regret not starting early. One decision taken today can quietly build your future. And when that future arrives, you will understand this was never about money. It was about discipline. And you chose it.